All right, hey everyone. I have been asked to do a session here on what I call the algo, which I have that in air quotes. I know you can't see that. But this is just an algorithm that is found in just about every market on every time frame. There are plenty of algorithms that are used out there for trading, generally controlled by bots, but often also controlled and written by people. This particular one is probably the most prevalent, but I mean, you have to realize that it exists alongside a lot of other bots and other algos, some of which are very similar, but maybe running in opposite directions. So there is competition always in the market again with these algorithms, but you also have other types that are very different than each other. You know, for instance, high time frame type of bot and competing against this type of Fibonacci retracement type bot. Okay, so in this session, I want to cover a few things. First, just to hit some disclaimers, this isn't financial advice. I'm not a financial advisor, and I also would not recommend using only this one method for your trading, but use it as, in a mix of other tools and strategies to kind of develop confluence in your trading. I'm going to start with how to use the Fibonacci tools in TradingView, just because I've seen so many people use them. I don't want to say incorrectly, but not in the ways that they are intended. And since this whole discussion revolves around using the two Fibonacci tools, I just thought that this is a great place to throw in some of my thoughts on maybe the best practices to use them. Okay. After that, I'll go into the algorithm's history, just briefly, how it came about, how people used to trade, and then how it kind of evolved into the state that we see it today. I'll also talk about different people of note that kind of realized this algorithm was at play and have written books and such on it, and then refinements that have happened over the years by some folks, as well as some of my own refinements that I've applied to it. And then lastly, we'll get into showing you lots of examples of how to find it in the charts and possibly use it in your trading. Okay, so let's get started here. Talking about the two Fib tools. There are two Fib tools in TradingView. You can find them here. There's actually a lot that are based on Fibonacci numbers, but the two that we're going to be looking at are the Fib retracement and the trend-based Fib extension. Okay, so these first two up here. Now the first one, Fib retracement, if you just kind of think of its name, it's used to measure retracements. So the way you use it, and actually this goes for the other tool as well, you always draw from left to right. So it doesn't matter if you're going up, okay, like this, left to right, or if we were going down, that's fine. You could draw it from the top over here, to a low. And we can measure retracements this way. So the key point here is it doesn't make a whole lot of sense to switch these around. So here, let me just start over again. If I was drawing a retracement to go backwards, say from this point to this point. Now you could say, well, you get the exact same thing. Yes, in this case you do, but if you are adding other features to it, this will only get you confused if you draw right to left. Okay, you don't have to get them on exact points and wicks like I just did there. If you're the type of person that likes using candle bodies, that's completely fine. You probably want to turn off this magnet then so that you can do something like this and just, well, let's say maybe I want the bodies here. Grab that and only measure down to the bodies here. That's not how I use it. I always go to the true high and low, which are going to be wicks in most cases, but you can do it like you want. Like I said, there's no incorrect way to use the Fibonacci tools, just the way that it was intended, and then you can take it from there and use it however works best in your particular strategy. In fact, I'm going to show you a method that David Halsey used, not necessarily in TradingView, but in his, I think he was using MT4, and the way he kind of manipulated some of the Fib tools there and used them in ways that were definitely not as intended, but they simplified his trading strategy. So that's fine. All right, so always go left to right. That's my advice. I'm going to turn this back on. And as far as how to use it, like I said, this is a retracement tool. So, I mean, that's in the name, right? It's the Fib retracement tool. So if we go from point, let's call this A to B, then what it's measuring is the depth of this retracement. So you notice that the numbers start low and go higher and higher. So the deeper the retracement go, the higher the numbers go. If you want, you notice there's nothing above this point. So if you want to see things above that, then you're either going to have to use the other tool or a trick that I will show you in a minute. Okay, so as you see right now, Bitcoin is just about to hit the 50% or 0.5 retracement. Okay, now let's talk about the other tool, the second one. The Fib extension tool, or it's called the trend-based Fib extension. This one has 3 points. So I'm just going to draw one really quick here, and then I'll talk about it. So the way you should think about this tool is it's taking the range of point A and B and then extending it from point C. Okay, so how would you use that? I know a lot of people do this, which, I mean, this is fine, where you go from the swing low to the swing high and back to the swing low. The only real reason to do this is if you are trying to get these numbers that are above the 1, right? Because remember, when we were using the Fib tool, 1 was the top. So here now we can have extensions above that. And you notice that this tool works in the opposite direction as the retracement tool, where the numbers, you know, instead of starting low and getting bigger and bigger as it goes down, they actually go up from the point that you extend from, and they continue past 1 if you want them to. Okay, so notice from here to here, and then projected from that origin point, we could see this, and yeah, there's some confluence points here. But often it's used to measure things like this, where you, let's say that if you were doing Elliott wave, and this was, you know, wave 1, wave 2, and wave 3, we might actually start over, draw it from scratch. All right, start from the bottom, wave 1, and the distance or the range of wave 1 projected, let's say, from wave 2. Okay, that'll give you an extension to try to target where you think wave 3 might end up. Or, like, again, an Elliott wave, and I don't want to make this about Elliott wave because this, it integrates well with Elliott wave because Elliott wave uses a lot of Fibonacci retracements and extensions, both to like kind of define where waves are typically found. However, you don't have to know anything about Elliott wave to do this algo following. So, like, for instance, 1, and we find the 4, often the length of the 4, or sorry, the length of the 1 extended from 4 will give you the top of 5, and it's usually between 1-to-1 and 1.272, sometimes reaching up to 1.68. Okay. Now, the trick I wanted to show you with this tool, and this was actually Giuseppe Biselli kind of started doing this. Oh no, I guess David Halsey did as well. So if you only, like, let's say you didn't have that Fibonacci extension tool, rather than doing that whole business of, you know, starting at the origin, going up, let's say we go all the way up here, and then all the way back down. What you could do if you want these numbers above is just use negative numbers for your Fib tool. Okay, so I'm going to do this, but I'm going to change it to, let's just change it to this. And you notice now I have a line above where I drew this, and it's at the -236. And we're going to talk about that number more here in a minute. But you see how it is in here. It's just a negative number. And by putting the negative number in there, you'll get lines above your fib range. Okay? And we'll talk about how you can use those here in a moment. All right, so this would be the point where I ask anyone if they had any questions about using the Fib tools. The only other thing I guess I would mention is like what I was just showing you there, that these Fib tools can be customized in many ways. Like you could turn individual lines on and off. You can put different values in for them. And you'll see I have quite a few templates saved, like the things that I use frequently. I have saved in here so that I can quickly just pick one of them, just like that, to get that. I also want to mention here at this point that your Fibonacci tool doesn't have to only use Fibonacci numbers. You can put whatever numbers you want in there and use it for other purposes. So for instance, let's go out to a bigger time frame here. I just want to show you if something like, so we talked about Elliott wave, but let's talk about wolf range. Okay, so wolf, the way that it works is we take a measurement of the first leg of a big up move or down move. Okay, so I'm going to use from here to here. That was kind of the first top. I'm trying to get right there. And I'm going to switch this to a wolf range with 50-50 splits. And I just want you to look at the last bull market here. And so this is what we did. And you see there's some pretty decent confluence. I mean, it's hitting some of the lines, but it's also missing some lines. So I wouldn't say that, you know, this was definitely the algorithm that was prominent and the one that was used in this. But we could do the same thing going down as well. So let's kind of move this over here, and I'm gonna that might be too big of a I mean, yeah, there's some confluence there, but actually we could probably get even better if we kind of only use the first move. I think that looks right there. Looks good. So, I mean, you can call, but the point I want to make here is that the way I'm using the Fib tool now is completely different. There's actually no Fib numbers on there at all. Okay, you just see it's all ones and 0.5s all the way down. Okay, so let's talk about the algo itself and its history. If we go way back, and by way back I mean like 100 years or more, and look at how people traded in the stock market, one of the things that they found was you'd have a move, and then a counter move, and then a continuation. Okay, and one of the things that they found is that if they measured the distance of the first move, let's see here, and that often it would go what they called the halfway back, but we would call it 50% fib retracement, for instance. So it would go 50% back, and then the length, so if this is A to B, the length of C to D would often equal it. So let's use our other tool to measure that. Okay, so from here to here, extended from here, and we just, let me clean this up so that we don't have to see all that. We just need to see this. So right there. Okay, so this was a very typical pattern that you would see in the market. 50% retracement, and then a move that's the same distance as the first move. Okay. Now, over time, what they were finding is that this was true mostly more and more only in corrections, but in impulses, it was not. And in fact, we would always see some type of pullback sooner, like around here, where from here it would come back down, and maybe eventually it would make it back up, or maybe not. So we needed to start kind of measuring this. And so at first, one of the things that they did was they measured, let's just use the one that's already drawn on here. I'm going to change this to typical. No, not typical. Yeah, let's use typical. So they were finding that this right here, where we were getting to, was somewhere in the vicinity of 1.272. Okay, as measured from the length of here back from the origin. Okay, so actually let me just redraw that so that it's more clear as to what I'm showing. From here to here and back down to the bottom. Okay, 272. So not making it back. This first leg's longer than this leg. Okay, and over time it kept shrinking more and more, and people found other ways of doing this measurement. But then, you know, when Halsey came around, he decided that, well, you know what, we're just going to take. He looked at lots of data and found that where it was really stopping was this negative 2.36. Okay, right there. And what was strange about it was that no matter how deep this went, whether it came back down to the 50 or if it came back down to the 618, it always still came right around this spot to this 0.236. Okay, now if it went further than this, then, you know, things would probably change. But anywhere in this range, and we would have a reaction right here at this negative 2.36. So that's different than what we were looking at before, right? Because if we, in the past, we're looking at a 1-to-1, then this would actually be higher, right? If we only went to the 50, you know, it would be up here. Okay, but if we went down here, then it would pull it back down. So the thing that he noticed was that this had to be algorithmically driven, because it didn't matter where the pullback went to, it always went to this same spot. And that, you know, if it went deeper, then something else usually happened. Okay. Now, he also noted that sometimes it went beyond this, and the secondary place that it usually stopped was, let's just turn on all of them, negative 0.618 and the negative 1. Okay, don't worry about this 707 right just yet. Okay, so sometimes we went here, sometimes we went here, other times we went all the way up here. Well, for those of you that know Elliott wave, you can kind of see, like here, this looks like a 1, 2, 3 or an ABC, because the C and the 3s are always the longest. They're always the best to trade because of that too. And if we actually look at this retracement, sorry, not a retracement, this extension, it's also 1.618, which is very typically a place to find a 3-wave ending or a C. The second most, you know, place that we find is right here at this 1.272, which, as you see, is also very close to this second target, if you will. Okay, so you're trying to build some confidence here without, you know, going all over the place. Let's see. So this is what we found for impulse waves. You know, the ones, but the corrective waves, like let's say we have a 4 coming off of here for Elliott wave, typically did not follow this as much. Here it was more typically found that it still was doing, you know, your standard length of A to B, 50% retracement, and this second length equals this length. Okay, so keep that in mind, that for corrections, you still may use the more traditional measurements as opposed to these algorithmic measurements. However, I say that, but you have to understand that this correction, which is a ABC type correction, actually is made up in this first leg of an impulse wave down, and then a correction, and then another impulse wave to finish it. So these algorithms still do have a place even in corrections that you can find and that you can trade. Okay. So now this is what I'm basically describing is the Halsey measured move. David Halsey, also known as emini-addict, I think that's his website even still to this day, which is emini-addict. I guess because he trades the E-minis, S&P. But so he wrote this book called Trading the Measured Move that kind of sort of defined all this for the first time and actually gave a strategy for actually how to trade it. Okay, now, and that strategy was wait for the first, wait for a move, wait for the retracement. That retracement will come between the 50 and the 0.618. Anywhere in here, you should scale into your trade, and then the first target is here, second target is here, and the third target up there if you're still going. Now it extends from, and also he found that if this goes beyond, then the algos are out of that trade. So what he found was that, because even if it comes here, this isn't going to be a straight line up. It's going to go up and then come back down, and then do some things as it goes up. If it goes up and it starts coming back down, the algorithms will, let's start here as it's coming down. They will start buying here at the 50, continue buying all the way down to the 618, and then hopefully it goes up. But if it comes back, they'll defend it until the 618, and then once it goes beyond that, they'll stop loss out, get out of the trade, and look for the trade in the opposite direction, which I'll get to that here in a minute. Okay, so what that means is you could actually, in the Halsey approach, you buy in this case, but this all applies to shorting if you just flip everything upside down. You buy in this range, sell here, and possibly here. If it goes below here, then your stop loss hits and you reload, try again. Okay, so what the point is, you're trading with the algos. This doesn't, this process, the only edge you're getting is that there's going to be algorithms that presumably have much more money than you do trading in the markets, and you want to trade alongside those large liquidity players because you're going to be more successful, honestly, than trying to trade against them. Okay, so that is that bit. Let's say that you get up here and there is a reaction, as you would expect, right here at this first target, because the algos, are selling off of their, they're taking profits at their target. Okay, so that's their first target. Why is this? Oh, there it is. Okay, so we come off of that. So at this point, what Halsey would tell you to do is that, okay, we need to reset now. And you remeasure from the retracement point that got you to target the last time, because that this point was used by algorithms, and you measure up there again, and you start over again. So again, once you get into this zone, you buy, and you hope it gets back up here to target, or that target. Okay, and you just continue this. Now, if in that first one, if it didn't have that reaction right there, but it continued up to the second target, then he would say that the market is in, so let's say it went like up to there, the market is in extension. So if we just blow past that first target with no reactions, we're in extension. And this is where he uses the Fib tool a little weird. So instead of measuring from here to here, we measure from the top of this one to the top of that as it starts retracing down. Okay, and again, you look for this zone between the 0.5 and the 0.618. Now, this is a completely nonsensical way, in my estimation, of using the Fib tool. Because I mean, why would you measure from a high to another high? It doesn't make sense because you're not really measuring a range at that point. But for him, it worked because it put this zone right in the standard buy zone. Okay, so I should have left that there. Let me leave that there. If I were to redraw it the right way, my right way, from this bottom to this top, but add in the 382, you'll see that, of course, I didn't draw this exactly as it usually kind of plays out, but what you would find is this 382 to the 236. So let's add that in too. Okay, that this little range from here to here is generally equivalent to this 5 to 618. Okay, and so I got so many lines on here. This gets really confusing. But like in Elliott wave, if you're measuring the distance of wave 2 to 3, you would expect a retracement between the 0.236 and the 0.382. Okay, from here to here, you would expect this to come somewhere in between here and here. Now, one of the things that I have found just personally, so this is like a refinement that you can add for me, is I have found that with Bitcoin specifically, this often comes to the 0.33. Okay, and right there, I'll use that as my entry point oftentimes. And again, this is in a, when we either we're doing Elliott wave and we know that we're in a wave 4 retracement, or you're using the Halsey method and you're in a market in extension, is his terms for it. Okay, so in this case, it will come to here. But remember, Halsey, he does this measurement. And actually, I have a, there, he would be looking for this 0.5 down to a 0.618. Okay, it's the same zone right in that groove right there. And then you have the same targets above. All right, the only other kind of refinement, I've talked about, Baselli's type of, his refinements that he made, and mine for that point. But there's also a guy named Sam Eels, who's better known as Trading Devil. And his contribution to this was that he realized that not only, well, what he realized is if we take the standard that Halsey set up, that in Bitcoin or in crypto, he was finding that this often broke just below the 0.618. And it was breaking to often the same point, and that point was the 0.65. Okay, so everyone knows, what this is called. This is the golden zone, the golden pocket. Yeah, but few people know that it was Sam Eels, Trading Devil, that kind of coined that phrase and was the first one that actually figured out this whole 0.65, because 0.65 is obviously not a Fibonacci number at all. It's just this pocket that it seemed that the crypto trading bots used. So they wouldn't abandon their trade right at the 0.618 like Halsey originally thought. They would wait till it broke the golden zone, the 0.65. Okay. Now over time, because he kind of came up with that 5 or 6 years ago, over time it seems like this has been getting lower and lower. And so Sam in his group, Trading Devils, started using this number, the 707, and I can't remember what it is, but 707 is actually a square root of one of these other numbers that we have out here. Maybe it's a square root of, no, I don't want to even guess. But he found that it was actually using that number. And so often now, I know in his methodology, they use 707 often as the breaking point where they put their stop loss there. For me, I've actually found that often it's been going a little bit under that. And so I've kind of built out this thing that I call the platinum zone, which is 707 to 747. And this is a zone that is I see quite frequently, especially with Bitcoin in like the last year, it hitting this zone. But so it's going deeper. However, the numbers up here, they don't change and they don't move depending on where you move this retracement. So yeah, my entry might change down here, and my stop losses might change, but my targets remain the same. Okay, as it goes there. So there's like all the specifics of the numbers. As far as that, the most important ones are you're normally going to get retracements between 0.5 and 0.618. That may go down to the 707, or in my finding here, the 747 as a pocket there. If you're looking at a market in extension, then you would either do the Halsey method of measuring from the top to the top instead of the retracement to the top, and look at the exact same zone, that 0.5 down to the 0.618, or you could measure from the bottom, as is normally done, and just go down to somewhere between the 382 and, like what I said I found is it often like hits there at the 0.33. So right in this zone would be the sweet spot for a wave 4 retracement. Okay, and then as far as places to take profit, negative 2.36, negative 618, and the negative 1 at the top. And there is one beyond that, the negative 1.618, that when we're going parabolic, you kind of frequently see. Okay, before we get to examples, I do want to talk about competing algos. Because I think I mentioned this briefly at the beginning of this video, but you have these algorithms running in both directions by multiple players at a time. So they're not always going to work because someone has to lose. And you end up in this situation where you have competing algorithms. So let's start over here. Okay, let's say you have this move that goes up, comes back down, to 618. Let's just start with that. All right, so it's going to be about there-ish. Let me actually measure it to make sure I got close. Okay, pretty close. So we hit the 618. As we're going up, you have to realize that there is probably an algorithm on the other side of this. So this is the buy side algorithm. There's probably a sell side algorithm running. So they're measuring from this top down to this bottom, and they're looking to buy in this zone from here coming down. Now, what you would find then is that it might stop there and we start reversing direction. And often you'd find that it stops right here at the original 50 from the first move. Okay, well, why do we think it stops there? If you look and we measure from here to here, that's going to be right in its, this same general area of this 618. So you'll see this frequently happening where we're bouncing between two golden pockets, or three golden pockets in this case, and which builds out like a triangle, really is what it's going to build in the end, and then it'll break one way or another. Whichever volume and algo is stronger in the market, it's going to break that way. Which is why I was saying earlier that often what you kind of see happening is if this goes deeper than the 618, okay, like maybe down to that platinum zone down here, that's when it becomes more likely that you're going to see a competing algorithm in here going in the other direction, because the longer this is, the more likely that this retracement is going to, you know, hit a spot where that bot can sell again. And you notice what just happened here. We can enter anywhere. This bot might enter in here, and look where its target is. Its target is actually at equal lows right here. So of course what you normally see is, you know, you'd probably break that to pull up the liquidity that's sitting under here, and then heads back up from that point. So there's a lot of things that kind of become confluent when you look at them like this. And yes, in a way, the more strategies you attempt to use in your trading, probably the worse off you're going to be, just because you're going to have so many different entry and exit signals going on. However, knowing how to use a lot of these, you know, this may not be your primary way that you trade, but it is a way of finding confluence and giving you some confidence in your trades. The biggest thing that you should just always know is that whenever you have an impulse move and you have your correction coming off of that, no matter where your particular trading style is telling you that you should take an entry, you should know where these pieces are, because no matter what, there's probably going to be some type of reaction at those points. So let's say you're coming down like this. This is probably going to have some type of reaction, and it might come back down here, and you're probably going to get some kind of reaction. Now it may keep going down, and that's fine. That means that this algo lost. Okay, the sell algo won. This buying side algo lost. However, it put up a fight, right? Started buying here, we went up, came down, defended, went back up, but then ultimately it lost. Okay, so that's just something to be aware of in the market. I actually have some measurements that I have that once I'm in a trade, I'll start looking at the opposite side to get confirmation that it goes past the 618 or past the platinum zone. Once it goes past that platinum zone, then I can be more comfortable in my trade. So what I mean by that is, let's say I enter here. Okay, right here, I'm still not comfortable. Here, I start becoming more comfortable. Why? Because when I look at the algo in the other direction, we've blown past the 618. Actually, I probably wouldn't, if I'm trading crypto, I probably wouldn't feel comfortable until we went past the 707. Okay, so once I break that, then I feel good. If we stop right here and start reversing, I have to start managing my trade, because there's a very good chance that algo is going to win, and we're going to go past and beyond my entry and hit one of its targets down here. Okay. All right. I'm sorry if that kind of went in all sorts of directions, but hopefully if I do some examples here, things might start clicking. Okay, so what am I in here? The daily. Yeah. I'm going to switch down to maybe a 4 hour. And let's just start looking from this recent bottom that we had here at 15 some thousand. I'm not going to go through the whole thing where, I do it in replay mode. But I mean, I can do that. I think that would be more valuable doing that as a live with you guys, if we want to either just so we can ask questions and whatnot. Here, I'm just to speed things up, because I haven't gone and cherry picked anything at this point. I'm just going to kind of eyeball things and show you probably how I would have done this if I was trading this method solely by itself. Okay, so from this low, here is where our first retracement starts. You notice it went right down here to almost the 618. Okay, came up. Let's zoom in a little bit here. Came up, got a little, hit the first target, and came back off. Now, as soon as this kind of came back down this point, that's where I would move my trade. Okay, so I'd take some profit there. I'd probably leave a little bit in, but I'm looking now for my next entry. So at this point, I would move this one up to the place where it started or did the retracement last time. And so let's say I'm here. That's the first place that it hit that. Okay, and notice it doesn't come down, goes higher. So I move this up. Okay, it doesn't come down, but it goes higher. So we go up, keep going up. Here, starts coming down, still doesn't reach my 50 entry, but then it goes back up again. So we keep moving this up. And finally here it comes down and it hits my entry point, just barely. Okay, so I would do another entry here. And you see it goes up and up and up, and then there right here it hits first target. Okay, it looks like it actually hit second target as well. Yeah, so up here it hit second target. Now, I could tell you that, okay, well, the next thing I would do is I would move this up to this point and this up to, you know, where it hit the first target, which was kind of this peak. But as you see, it kind of just comes down here, and we're reversing. We're going in the other direction. So that's fine. Let's look at this going in this direction. Actually, I'll do a 1, but I know that this isn't going to yield anything, so I'm not going to spend a lot of time on it. But I would go from here. Here's the first one. Never reaches back to our entry points. Here's the second. Pull back. It's pretty weak. Nothing there. Down here, no pullback. Then we go all the way down here. Still, we just go like this forever. Right here, we hit a possible entry. So here I would probably short, but you see it pretty quickly goes bad. So this would be a loss on this. I would probably have had my stop loss just on the other side of the 707, or if I wanted to keep it tight, do this. Although in my case, I know I would not have actually entered because I'd be using other tools to tell me that no, momentum has shifted. And you know, we have a change of character right here, and we're going up. Okay, so let's look at this going in this direction. Now from here, let's say to here. No, wait, first one's right here. Okay, we never reach it. This one kind of gets a little front run, but it actually never reaches the 0.5 right there. So I probably wouldn't have entered there. I don't know. And then we go parabolic, so I know there's not going to be any pullbacks in this section that are worth looking at. I don't know. That's probably enough. If we were looking at this like on a bigger time frame, you can kind of see, like I see one right here, likely from here to here. We hit the 50, goes to first target, goes to second target, and actually I hope we don't get down there to the third target because I think my stop loss is before that. Well, where are we right now? Let's see, low of 20,050. So hopefully we're heading back up there because I know I have, yeah, that's not hit my stop loss, but anyway, that's a big low we have there. Also want to mention that this does not only work on Bitcoin and crypto markets. If I pull up, like let's pull up the S&P. I don't know. Let's look right here. What are we at? 4 hours. You guys know that like 4 hours is not really a legit time frame for stocks because it doesn't divide the days equally. Here, we can do 130 minutes. That's 3 times a day. Okay, so if we look from here to here, you see it goes to the 50 and goes to the second target. So that's a win. And then we would move it to here and there. And of course here we would get down into this zone. And so that, you know, we've reversed. That's a loss. But if we look at it going in this direction, it has hit the 0.5, so you would probably, I would anticipate that it would likely get down to this first target at least. And of course, confluence wise, that is equal to this bottom right here. So there's probably a lot of support there. That makes a good target. I could go through more of these, but you just find this everywhere, and it doesn't matter what time frame you're looking at. It's just a fractal pattern that appears everywhere because there are algos running all over the place. So some of this is people trying to follow the algos using various people's methods, but the majority of it is all algorithmically driven by bots. And the whole point of trading in this method is that you gain an edge by trading with the higher bits of liquidity. Okay, so that's how you see them repeat over and over again. So if you have questions on this, I kind of did this a little bit just off the cuff. So if you found anything confusing, I'd be very happy to jump on a live session with people and kind of answer questions as we look through more specific ways of maybe how you would implement this. I will say that this was the method that I used to use more so than I do today. I'm more of a smart money liquidity type trader now, but I do still trade this method, especially when I'm doing quick scalps during the day. And I think if you go back and look at my Twitter account, I actually called the bottom of the 2018 bear market like a month leading into that low using this method, because we almost perfectly hit the big down algo target there. Actually, let's just look at that real quick, and then I'll kind of finish up. So if we go to the daily on BLX, back here to (2008). Where are we? Sorry, 2018, not 2008. All right, I think we're here. All right, so this is the peak of 2017 in December, the start of the bear market. And if we measure from here at this peak to this low, I think it was this one. You know what? Maybe it might have been this one. Yeah, it was this one. So that kind of reminds me, one of the things you have to understand is, like, if you're used to thinking things through like an Elliott wave, you would say, well, why are you measuring from this? That's not the high. This is the high up here. The algos don't care about Elliott. They don't know anything about Elliott wave or anything structure-wise with the market. All they see here is a pivot high and a pivot low. And so this algo saw that pivot high and pivot low, traded it here at the 50, and we basically went right down to target. And then this was the end of the bear market. From here we went up. Okay, so that is all. Please send me your questions, and I hope you have enjoyed this and I wasn't too scattered in the descriptions. Thanks.